What exactly does it take to be a king of dividends? A stock that has at least doubled its dividend payout over the course of the last half-century every single year. There is a good chance that the majority of these dividend kings will remain on this list throughout the entirety of the year 2022. Why? Companies that have maintained a continuous pattern of dividend growth for more than half a century are under a tremendous amount of pressure to maintain that trend moving forward. This pressure is expected to increase in the coming years. Here are the 5 dividend kings to buy. Number 5. 3M Company. More than 60,000 of 3M's products are used on a daily basis in families, medical facilities, business organizations, and educational institutions all across the globe. These establishments include both private and public settings. Approximately 95,000 people are employed by the company, which serves customers in more than 200 countries across the world. At the moment, it is composed of 4 individual departments, or business divisions. The Safety and Industrial Division is responsible for the production of a variety of products, including but not limited to tapes, abrasives, adhesives, and software for the administration of supply chains, in addition to the production of personal protective equipment and other security-related items. Number 4. Cincinnati Financial. It is a stake in financial services or insurance provider. The company not only sells insurance for businesses, homes, and automobiles, but it also sells a range of other financial products, such as life insurance, annuities, property insurance, and casualty insurance. The company's primary focus is on providing insurance for individuals and businesses. Considering that it is an insurance company, it accomplishes this goal in 2 distinct ways. It achieves this goal by first collecting premiums on policies that it writes and then investing its float. The float is the sizable amount of money that results from adding the time value of the premium revenue to the amount that it pays out in claims. This process creates the total amount of money that the company has available for investment. On July 28, 2022, it made public the findings of an investigation of its financial performance during the second quarter. Earnings per share adjustments came in at 65 cents, which was 39 cents less than what industry analysts had projected, and earned premiums came in at $1.77 billion, which was $190 million less than what industry analysts had predicted. Up until the year 2027, we forecast that our EPS would increase by 6% on an annual basis. In addition to that, the share price now has a dividend yield of 2.8% at this point in time. Last, but certainly not least, it would appear that the share price is well below what it should be. It is projected that annual total returns will average 12.1% throughout the following 5 years of the investment's life. Number 3. Parker Hannifin. It is an industrial producer with a diversified product line that specializes in motion and control technologies and has a strong focus on innovation. Since its founding in 1917, the company has generated annual revenues of close to $14 billion throughout the course of the past century. It has successfully increased its dividend payment for an incredible 65 years in a row, bringing the total number of years that it has been paying dividends to 71. In the middle of this year, it published a report detailing its financial performance for the third quarter of the fiscal year 2022. Strong demand in virtually all markets was able to more than balance the negative effects of cost inflation, which ultimately resulted in a 9% increase in sales when compared to the same quarter of the previous year, and a 17% increase in adjusted earnings per share, which increased from $4.12 to $4.83. Not only did it achieve record sales and earnings per share, but it also surpassed the predictions of industry analysts by an amount equal to 18 cents. In addition to this, it boosted the dividend by 29%, while also decreasing its expectation for adjusted earnings per share in the fiscal year 2022 from $17.80 to $18.30 to $18 to $18.30. Number 2. Computer Services. It provides regional banks with a comprehensive range of services, such as solutions for core processing, digital banking, payment processing, and regulatory compliance. It is considered a small-cap stock because its market capitalization is under $1.4 billion, which is comparatively low to other stocks. The corporation primarily focuses on enterprise banking and business solutions as the 2 key business components that it provides services for. The enterprise banking group is the most important section of the company, accounting for around 62% of the corporation's overall revenue. It has raised its dividend, earnings, and sales for a combined total of 50 straight years, for 22 years, 25 years, and 25 years respectively. The management team of the company forecasts that the aforementioned metrics will achieve new all-time highs in 2018 as a direct result of the powerful momentum that the business is currently experiencing. In the past decade, the company has expanded its earnings per share at a rate that is 10.2% faster than the yearly rate that is considered to be the norm. The outbreak has had no negative impact whatsoever on the company's overall performance. From the extraordinary track record of revenue expansion that the company has had, it is possible to deduce that the business plan that Computer Services developed will be successful. The company offers its customer a wide range of options for service delivery. In exchange for their business, they agree to sign multi-year contracts with the company. Because of this, it is extremely inconvenient and costly for these customers to terminate their relationship with the company, which is made even more problematic by the fact that they are required to pay significant early termination penalties, which further exacerbates the problem. The company now has a dividend yield of 2.8%, and we forecast an annual EPS growth rate of 8% for it. It is expected that an increase in the price-to-earnings ratio will add 1.7% on an annual basis to total returns, which are anticipated to reach 12.5% on an annual basis. Number 1. Lowe's Company. After Home Depot, Lowe's Company is the home improvement retail establishment that holds the position of second largest in the United States. More than 2,200 home improvement and hardware stores in the United States and Canada are either serviced by Lowe's or are run under the company's auspices. On May 18, 2022, Lowe's disseminated the financial results of the first quarter of that year's operations to the public. The entire sales for the first quarter of this year came in at $23.7 billion, which is lower than the total sales for the first quarter of the previous year, which amounted to $24.4 billion. A reduction of 4% was seen in comparable sales, while a decline of 3.8% was seen in comparable sales for home improvement in the United States. It is essential to point out that revenue generated from sales to business customers rose by 20% compared to the previous year. The net earnings of $2.3 billion were very similar to the statistics that were reported for the first quarter of 2021. The company's diluted earnings per share increased to $3.51 from $3.21 a year earlier, representing a 9.3% increase in profitability. The company repurchased 19 million shares of its own stock during the first quarter of the year, spending a total of $4.1 billion to do so. In addition to that, they dispersed dividends altogether amounting to $537 million. The amount of cash and cash equivalents held by the company presently stands at $3.4 billion, ensuring that the company is in a solid position in terms of liquidity. The company has provided a projection for the forthcoming fiscal year, 2022, and anticipates that it will be able to achieve diluted profits per share in the range of $13.10 to $13.60 on total revenues of roughly $98 billion. This is according to the expectation that the company has supplied. Lowe's predicts that it will buy back common shares with a total value of $12 billion in the year 2022. The combination of a higher multiple, an anticipated increase in profits per share of 6%, and a dividend yield of 1.8% results in total predicted returns of 14.5% per year for the upcoming period. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.